the goal here is just to have a casual conversation about investing. And what I'm trying to do is to interview the best investors around, um,
Yeah.
public markets investors, and they can be young or very experienced. In your case, very young, but you're one of the most talented young people that I've ever seen in my career.
Thank you very much for your kind words, Nathan.
So I'm super happy
Too
to.
kind. You're too kind.
Oh no, it's you're incredibly talented. So I wanted to have a chat, learn more about your strategy, learn more about you and about your views of the world. And so this is meant to be a 1 hour conversation.
Yeah.
Um, and so looking forward to it. And so maybe you can introduce yourself and tell us how you got into investing and finance.
Well, I got interested. Well, I went into finance in 2019 when the COVID, 2020 when the COVID crash happened. I lost all my savings. I was like playing with options. I didn't even know what I was doing, and I lost everything. So I started studying. I started like implementing what I was studying in the markets. And fast forward a couple of years, and I started working at a hedge fund in Madrid called Quadriga. In their hedge fund, it's called Rho Investments. And I focused on macro strategies. I was doing like macro analysis, fundamental, using basic tools like Excel. And then I went to Frankfurt School of Finance, and there is where I learned how to code. And when I learned how to code, I started my own company called Alpha Rho Technologies. This is because I saw a huge gap technologically wise in the current industry. So I decided to exploit this myself. And what we are basically doing right now is implementing like advanced quantitative techniques into macro analysis. And I'm currently managing a mutual fund, which is called Global. Well, I'm not managing, I'm advising a bank's mutual fund. And this fund is called Global Dynamic Allocation. And we basically invest in equities, fixed income, and currencies at a global scale.
Understood. And how old are you today?
I'm 24.
24. And you're 24 and you're already, managing, your own fund
Yeah.
that you've launched not long ago, right?
Yeah. Like the actual manager is the bank, and I'm advising the bank implementing our technologies. Yeah, and we have been like developing this technology for the past 3 years. Yeah.
Yeah. And ever since ever since I came across you, I thought it was pretty incredible what you were doing, and for everyone to understand, the purpose of your strategy is to achieve S&P like returns with less volatility. Is that correct?
Well, the return objective is to obtain 500 basis points or 5% above Europe's core inflation
Yeah.
with the minimum volatility. So for now, and the objective right now, the nominal one would be 5% plus 2.3, which is the core inflation now in Europe. So it would be around 7.3. So what we do is adapt the portfolio in terms of fixed income, currencies, and equities to achieve this goal with the minimum volatility possible. So yeah.
Understood. And why did you decide to go into a quantitative strategy? Because you've actually built an incredible amount of financial knowledge, especially for your age. I've always been impressed by it. But yet you decided to not go into stock picking or kind of traditional financial or macro-based analysis manually, but to go into a pure quantitative strategy. So why is that?
Yeah, very good question. I did this because humans have emotions, and this can add volatility to the portfolio. I mean, like sometimes you are in a good mood, so you take better decisions. Sometimes you are in a bad mood. There's a lot of factors that can affect your performance, and I wanted to develop a solution that is consistent. So algorithms don't have emotions, so they deliver, in my opinion, a more consistent returns over time. And that's basically the reasoning behind for the client side. And for the business side also, quantitative models are much more scalable than discretionary trading, because I can develop a model. Like currently, we have a model for global multi-asset, but I can train my analysts, my AI analysts, to trade, I don't know, US equities only or European equities only, and have a lot of strategies for the same cost. If I
And
were not to use quantitative strategies, it would take me many teams in order to manage all of these strategies. So scalability is also a big factor.
so two questions. Can you give more details into how your technology and code works? And secondly, we're at the end of August 2025. What does your strategy recommend? So how's your strategic position today?
Okay, so an overview of how our technology works. We have basically digitalized asset management. We've replaced analysts with AI analysts, and we basically train these AI analysts to manage a defined investment universe of ETFs and about like ETFs like regional, sectorial, fixed income ETFs, whatever, and to achieve the desired return objective. And in terms of the latest recommendations, we are overweight equities over fixed income. We are 61% in equities, which is like our benchmark is the 60/40 portfolio. So we are 1% overweight equities, and we are a bit underweight fixed income. We are 36% fixed income and 4% gold. And in terms of equities, we are currently overweight technology, US as a region, Europe, and telecom as sectors.
And how, technologies, so the Nasdaq is reaching all-time highs. And so can you
Yeah.
explain why your code, your tech is recommending that kind of allocation today?
I mean, we have 151 AI analysts, which are ranked as in a traditional asset manager, and our top 10 analysts make it to the investment committee. And what they do in the investment committee is they present their ideas, and they basically forecast expected returns for assets. And since our top 10 analysts were saying that telecom and consumer and technology sectors were the ones with the highest expected return and the lowest expected volatility in terms of that return, those were the sectors that were selected for this quarter.
Okay, so it all depends on who are your top 10 AI analysts across
Yeah,
your
exactly.
150. And so how is that defined?
Like each analyst has its own interpretation of the data. We feed each analyst with fundamental data, macroeconomic data, for example, US unemployment, inflation, interest rates, stock prices, and the other input is price data of the investment universe. So they analyze, for example, how has like the momentum in, for example, the technological sector, and how has the technological sector performed when momentum was similar in the past, And since each AI analyst has its own opinion, we select the ones that consistently outperform, in terms of, we imagine everybody has an opinion, but their opinion is not as good as others' analyst opinion. So we select the top 10, and then we do the inverse of the bottom 10, That's another thing we do. We have very bad analysts, and what they do, we do the inverse. So that's also a thing we do right now.
Understood. So in short, you're always comparing the current situation and you're going through history. So,
Yeah.
And I don't know, is that 100 year of data or how long?
Depends on the asset, but we have data for most of them since 1990.
Since 1990. Okay.
Yeah.
So anyway, you're going through history, and then you're asking your AI analyst in a comparable situation, what has outperformed in the short and medium term.
Exactly. They are ranking the assets based on several factors, including the one is expected return.
Understood.
Exactly. Yeah.
So, and so, for example, you said you have a single digit gold exposure today,
Yeah, we have 4% gold
right?
exposure. Yeah.
And so, why does your AI team not think that gold, should be more overweight today?
I mean, based on their assessment, gold should it should have a role in the portfolio. It's also adds diversification benefit, but its momentum has stagnated for the moment. So unless the momentum reaccelerates, I believe the analysts won't allocate more to gold. Like
Understood.
gold is also an asset that is very momentum driven. Once it starts falling, it's better not to buy it than once it starts rising. That's historical patterns. I don't know if that will repeat in the future, but that's what usually happens with gold. So that's why we reduce the exposure. We also have some data coming in about political uncertainty with, Trump, Russia, Ukraine, Israel, Palestine, So this uncertainty also adds some expected return to gold in terms of fundamentals. So that's also why it's 4% and not less. It's a mixture of things.
Understood. And to what extent do you have human input? Because you have your code base, but then I think always the question with quantitative strategies is to what extent can a human manager influence its own AI team to go one way or the other? And so, what would you say here?
Yeah, that's a very good question. The AI team is thought of as augmenting or helping the manager take informed decisions. In the end, the AI team presents me a table with all the assets and expected return, volatility, minimum expected return, maximum, median return. So the manager has an idea of how they perform, what to expect in a similar environment. Of these assets, so you can take an informed decision. Like the system recommends you these 3 picks, and the manager should decide, okay, does it make sense?
So you
So
have a manager
yeah,
that has a final say here, a human
yeah,
manager.
exactly. I'm the advisor, so I'm also revising the output, and then I send this to the bank, and the bank revises this, and then they execute the advice, the portfolio, the trades.
So it's essentially the flow is the AI analyzes and recommends, and then a manager has a final say
Yeah.
where you can approve or veto.
Exactly. What we do is say, okay, imagine the system said, okay, the top 10 analysts have recommended an exposure of 5% to China. And of course, a war between Taiwan and China is not on the table. It has never been, historically, it's never happened. So the analysts don't take this into account in the calculation. So as a human, you can add some input. You say, okay, don't invest in China. Recommend me a new portfolio, a new allocation. So they will drop China and they will recalculate all the weights again. And that's how we combine like the human input with the AI system.
Understood. And so speaking of which, China. So the 13Fs came out recently, and I think it's been a few quarters that there is 2 teams on China. There's the guys that say, avoid China at all costs, the guys who say China is cheap, and if you take a long-term perspective, it's worth going in, or at least having some allocation. So
Yeah.
what stance do you take here?
I mean, China has been gaining a lot of momentum. It is true. It's very cheap if you compare it to the US, but also you have the policy risk, right? The fiscal, there's the regulatory, you never know. This government can do whatever they want with the companies. They have done so in the past with Alibaba. So there's a lot of risk premium tied to it, no, in terms of regulatory risks. So yeah, like technically speaking, it looks like it's gonna break to the upside, but I've seen a lot of bullish commentary on LinkedIn, and there's I think sentiment is very optimistic now. We used to have China on the previous quarter in the portfolio, which did very well, but we have since removed it in our last rebalance. I don't know if we are going to miss the upside movement, but for the moment, our analysts think China is not a region to be overweight at the moment.
Your rebalancing happens how often?
Every 3 months, every quarter, starting January. Yeah.
And why did you pick every quarter and not every week or every month?
Yeah, I picked every quarter because, like for example, GDP data comes every quarter. You also have financials come every quarter. Many data, macroeconomic data regarding aggregated financial data, like for example, banks, credit, this type of data comes on a quarterly basis. So it didn't make sense to be refreshing the portfolio every month if we don't have the new data available. And also to minimize transaction costs. We want to minimize costs as much as possible, reduce turnover, whatever, because in the long term, this is huge.
And so if we look at the recent history, say, what were the positions that saw a big change in your rebalancing? So you just said you used to be exposed to China, that went out. What else has seen a big change in the last, say, 1 or 2 rebalancings?
Yeah, we were also like, we had a 10% allocation to gold, and we have cut this to 4%. And we also had exposure to minimum volatility ETF factor, and we cut it down to 0 also. We also had exposure to momentum factor. We cut it down to 0. And we increased our allocations, to the tech sector, to telecom, to US and to Europe. And that's how we concentrated more our portfolio into these factors and regions for the moment. We also increased our risk now going into August by increasing the equity exposure. We were also underweight equities during the Trump tariff thing. It wasn't great looking back because the equities have rallied a lot, but in the moment our system detected maybe this could persist a little bit longer and uncertainty, but in the end everything was resolved quite quickly, which was surprising.
Understood. And so, essentially, your system didn't foresee the V shape, but I guess it's a risk-reward based approach. And clearly, your system didn't think that the reward was worth the risk.
I mean, it had like 56% exposure to equities instead of 60, which is our benchmark. Right. It thought that it could go like lateral or maybe go down a little more, or volatility was going to be higher, like choppy. So it allocated to gold and to fixed income. Yeah. But in the end, equities rallied a lot and gold stagnated. So that's why they cut losses now. It didn't cut losses in gold, but it reduced the exposure. And went long equities now that everything looks clear, there's less uncertainty.
Understood. In terms of a few questions, in terms of currencies, are you balanced across multiple currencies? We've seen a lot of movement in FX year to date. So what do you think about this?
Yeah, we have our fixed income hedged to euro. And in terms of equities, we have dollar. Well, 60% of the portfolio, more or less, is dollar, and 40% or 35% is euro. Well, 36% euro and 4% gold. So that's how we manage currency risk on an active level. For now, we think euro dollar is pretty high. It averages around 1.10. So we think there might be some downside to the euro dollar. Now, maybe it goes to 120, but more than 120 would be, I think, is low probability. Although rates in the US have more downside than in Europe. So in the short term, we might see some euro dollar strength. But in the long term, the technological innovation economic growth is in the US, in my opinion. So that's a bullish driver for the dollar. So in the long term, I think euro dollar will be stabilized around 1.10. And in the short term, it could go 120, but I mean, the risk reward you can see, it's around now, it's euro dollar is around 1.16 or something like this. So I think risk reward is better to the downside. So that's why we have 60% dollar, 36% euro right now in the portfolio, 4% gold.
You're just so to clarify for everyone, you're only allocating to ETFs.
Yeah.
You don't have any single stock positions.
No, exactly. We only allocate to ETFs because we believe the information asymmetry is very high when allocating to single picks. We cannot compete in terms of data with a big asset manager that has maybe the management on call, so we compete at a macro level. So what we do is select regions, factors, sectors to invest in rather than single companies. And we also avoid with this big financial losses because companies can go to zero, but a sector is very unlikely it will go to zero, So that's also a way of protecting our investors' capital. Since I also invest 100% of the money, my money in the fund, so I also want to protect this,
Understood. So it's do you have any short positions in the portfolio, or is it normally?
No, we can have some temporal short positions for hedging purposes, but the portfolio is a long-only strategy.
Understood. And you said you have right now a 4% allocation to gold, down from 10. Do you consider other metals, so silver, platinum, all that? Is it considered, is your lack of allocation a deliberate choice or not?
Yeah, they are not present in the investment universe, so they are not. We cannot invest in them for the moment.
And why not? So there's silver ETFs and so on. So why not?
Yeah, I mean, we believe like we have gold for a hedge against like currency debasement and geopolitical risk. I think silver is more like speculative risk. It has a positive beta with equities. When there's risk on, silver does very well. But I don't know. I believe gold adds more diversify, like it diversifies the portfolio more than, for example, silver. We will be adding more risk if we add silver, in my opinion.
Understood. And so similar question with crypto. You didn't mention any Bitcoin or the likes allocation.
Yeah, for them, like Bitcoin, the problem with Bitcoin is has very limited track record. Like, I mean, you can only take its data since 2018. So compared to our other assets that have data since 1990, there's a problem with this. When our analysts take a decision, maybe for Bitcoin they have 200 data points, and for real estate sector they have 3,000. So there can be problems when comparing apples to apples there. So we have excluded Bitcoin from the active management. We might include Bitcoin as a static allocation in the future, like for example 1% of the portfolio without active management. But for now we don't have it. If we see a lot of client demand for it, we can consider adding it to the portfolio.
Understood. And so you said you have all of your personal money into the fund.
Yeah.
So if you were to recommend to a retail investor with, say, a $1 million net worth, what kind of allocation would you say is healthy to allocate to such strategy?
I mean, it depends. Like what I usually say is I run like a core satellite strategy where I do a core allocation to a global multi-asset fund, such as mine, which is around 70 to 80% of the allocation. Why? Because you have a core exposure to fixed income and equities. And this is actively managed for you, depending on the macro environment. And then the other 20% can be reserved if you want to play, for example, you're very bullish Nvidia or you're very bullish tech sector, you can play with this 20%. So this is like play money, So you are calm. But if you fail with this 20%, you have the 80% core, which is like goes with the market. So your financial loss is limited. So this is usually the strategy I usually recommend to family, friends, clients, whatever.
Yeah,
And I personally run this one.
Yeah, I agree. It's already your strategy is by definition very diversified, and it runs a near 60/40, which is kind of the classical template to allocate.
Yeah, we try to outperform the 60/40.
Yeah,
This
and
is our benchmark.
understood. And you would recommend clients, to go in with a bullet allocation or to go, in a more fragmented way.
Yeah, I mean, I cannot recommend for legal matters,
Yeah.
but what I would personally do is bullet. Why? Because historical evidence has shown that investing everything as early as you can has the highest expected return. If you do a DCA, normally the market drifts higher, so you are going to end up buying at higher prices unless there is a 2008 recession or whatever. Then you're very lucky because this happens very few times, and then you can buy at lower prices. But normally 90% of the time the market drifts higher, and the market trades around 60-70% of the time at all-time highs. So also this is a thing to consider. Buying at all-time highs isn't as bad as people think.
Yeah.
Because the expected return at 3 month, 1 year, 3 year, 5 year on the S&P, for example, at all-time highs is positive and even greater than buying at -5 drawdown. Because normally when the S&P falls -5, usually something it falls even more. So that's why the expected return on all-time high is higher than maybe at -5.
Yeah, and that brings me to two things. One, I fully agree with you. Timing the market beats timing the market. That's a well-known phrase. With the one caveat being age. Probably if you are older, so if you're at retirement age, 70, 80 years old, then a bullet allocation starts making less sense because obviously then there is succession and there is a higher probability of death. And so if death would coincide with a large drawdown in the market and you've just done a bullet, then it is problematic. So of course I'm talking about someone who would be entering the market at a late age.
I agree with you, but the thing is, if you are, for example, 80 years old, you want to have a greater exposure to fixed income, for example, because you are at an age where you want to start withdrawing money. Yeah.
Your fixed income allocation should be the same as your age, right? So if you're 80 years old, you should be an 80 fixed income, 20 equities, if you're 50 years old, it's actually should be closer to a 50-50 and so on and so forth. So
that's a good framework if you are working with static allocations. That's perfectly fine. Yeah. But the thing is, the macro environment doesn't care about your age, and in the end, like you have, this is what drives equity and fixed income returns. So maybe, given the current macro environment, it's sensible to allocate something to fixed income, independently of the age you are in. Because markets, they go up higher, they go higher, equities go higher than fixed income, but fixed income can give the investor better risk adjusted returns when combined with equities. So I believe fixed income should be in everybody's portfolio. Of course, if rates are positive. If rates are negative, no. But in current conditions, like the 20-year bond in the US is giving you 5%. This is an incredible equity hedge in case of a recession. I believe it's a great asset to have in everybody's portfolio. Of course, not like 20% allocation, but like sub 5%, something like this. We have that in the fund. If you want to have the same risk as an S&P, you can have an equity and bond exposure and lever it up. and you will get more returns for the same level of risk. But yeah, that's a more sophisticated strategy.
Speaking of which, so you talk about fixed income exposure. So what's the split between your short duration, medium, and long duration? You were talking about the 20-year, the TLTs trading
Yeah.
at 85 or something like that. And so what's your exposure to a TLT versus a 0 to 3 months duration?
Yeah, we have around 3% exposure to long-term, like 20 plus year bonds in the US right now. We believe, well, 3% is good given the duration risk it has. And we have this as a hedge, an equity hedge. If there's a recession or economic shock, these rates are going to go down hard. So TLT is going to go up very a lot. So we are going to be able to rebalance this and buy equities cheap. And in terms of the rest of the duration in portfolio, we have a duration of around 5%. Yeah, 5. So we believe they're the highest risk reward there, given yield to duration ratio. For those who don't know, the yield to duration ratio is how much yield am I getting for every duration. So if it's 1, even if interest rates go up by 1%, the yield is going to compensate this loss for you. So you're going to end up flat.
Yeah.
So the higher the yield to duration, the greater the risk to reward ratio.
Understood. Now, steering a little bit away from the strategy. So what you said is you would recommend or an average retail investor to have a substantial allocation to a macro diversified strategy like yours, but then still have a 20% pocket to do some directional bets. So if you had that 20% pocket yourself, what would be the bets that you do either on the long or short side?
Yeah, I do actually do it in the fund. We are overweight tech for the moment and telecom sectors. So I believe, and also we are long Europe and the US. So I believe these are now the satellite allocations within the fund. And that would be also my personal bets for the moment.
You see your long US tech, do that through a NASDAQ ETF or something more?
Well, not US tech direct. We are long the MSCI World Technology Index.
Yeah.
And in terms of the US, we are long MSCI Europe, US and Europe also. We have 5% allocation in each.
And so why Europe? Is that a valuation catch up?
Yeah, like the analysts saw better risk reward in terms of you saw a lot of currency volatility these past months. So since our fund is base currency is euro, having exposure to Europe has been also reduced volatility, and also Europe has been doing very well compared to the US since Trump made like these tariff announcements, and he is causing a lot of volatility, and Europe has been initially benefiting from it.
And when you think about a medium to long-term view, don't you think that there's too many problems in Europe? The economic life is way less active than in the US. You have the political risk, you have the fragmented nature of Europe, you have the lack of reforms. A lot of countries are very indebted, and so when you put all of these issues together and you compare it with a very proactive capitalism in the States, how does your view change?
Yeah, like for the moment we are tactically overweight Europe. I mean, this can change the following quarter. But yeah, long term, everything has a price. And Europe was initially, everything you said, I completely agree. But Europe was trading very cheap. So, this was priced in. And now some improvements are starting to be priced in. So yeah, everything is very pessimistic, but what's priced in, So yeah, in the long term, I believe the US will do better. Obviously, all technology like Europe is completely fallen behind. They only want to regulate, so we have a lot of problems to solve. And I mean, this is limiting Europe's growth. But yeah, valuations are also very cheap, and they are like repricing. So everything has a price.
Yep. And I think the beauty of your strategy is that you're constantly reassessing every 3 months the risk reward, the
Yeah.
new conditions, and then the value of each ETF line. And so there's no dogmatic approach. I was long US, therefore I remain long US. Everything is being reassessed every 3 months.
Exactly. And what we do is also continuously improve the system. My day to day is basically working on improving the system, trying new features, testing, researching. That's my day to day.
Yeah.
So with every rebalance, we get a better system, better decisions. And also we get more data every day. The financial markets generate data, so our analysts have more data to analyze, and their performance should then improve as in the future. It has a positive carry.
And what do you so you have a major macro event happening? So say I don't know, China invades Taiwan, or you have the tariff issue that we had in April. So suddenly significant drawdown in global equities or in US equities. We're talking 15-20% drawdown. What do you do? Do you stay put and the next rebalance, or do you have an intervention?
We stay put till the next rebalance. Normally, when events like this happen, there's some mean reversion also happening. So if you are trading a big fall, maybe you can lose a lot of money. I mean, if you sell and then the market goes up by 5% the next day, I mean, we prefer not to trade when there's high volatility. Also, transaction costs jump by a lot, and we prefer to take decisions on like data-driven decisions every quarter, assessing things when they are calm. And we take a long-term view. We don't take a short-term view. So yeah, events like this can happen. They have historically happened, and the strategy has done well. It has done better than the benchmark.
Yeah. The faster the drawdown, the faster the recovery.
Yeah, normally.
Normally, I think it's a historical truth. There's been many studies showing that. And I think what's interesting in your approach is that you remove the emotional bias, where whenever people imagine their own portfolio, the temptation to be selling in a decline is very high. But here you have a discipline approach where you say, well, no, the rule is every 3 months, no matter what.
Yeah,
And because the
exactly.
strategy is diversified and you already have natural hedges in place, then
Exactly.
your portfolio already is good at absorbing any shock. If equities decline, then fixed income or your gold strategy
Yeah,
will behave differently. Yeah.
exactly. And also the TLT, for example, it's a very good hedge,
Yeah.
because even though like it gives you positive carry, you are collecting coupons. It's not a hedge that doesn't deliver returns. You are constantly receiving dividends, so it's a natural hedge that gives you coupons. So it actually pays you for having it. Of course, it has duration risk, whatever, but at 5% interest rates, like, come on, how high can they go?
In earlier on, you were saying that your very first experience in the markets before you gained that incredible amount of knowledge in record time, by the way, was trading during COVID. And so, what happened there? Obviously, this was a huge decline, and also a very heavy recovery. Although it took 6 months, which is actually pretty fast. But by the end of 2020, things had recovered to the pre-COVID levels. So, what did you do then?
Yeah, I was at my university class. I was in a popular retail broker called Plus 500, and I saw equity options of Alibaba going up like call options going up in a day like 300%, like weekly options. I didn't even know what options were back in the day. So I decided, I went in a demo account. I had like 50 grand demo money, and I bought some random options, and I did like 300K in a day. And I was like, come on, this is crazy. I'm the best trader in the world. So I put all of my savings in plus 500. It was like around the time was like 1,000 euro. And I bought another call option of Alibaba. And I lost everything. The COVID came, and it was a call option. So it went to zero. And I lost my 1,000 euros, and I felt really bad. You know, a loss feels worse, like twice worse than a win. So you can imagine my feeling. But I am very happy this happened to me very early on, because it was only 1,000 euros I lost. Imagine if I would have bought Alibaba puts with that 1,000 euro, and the COVID crash hits, and my puts turn out into, I don't know, 200,000 from 1,000 investment. That would have done the most damage, because I would believe I'm the best trader in the world.
Well, you would have lost the next round. You would have lost everything.
I
Something
would
else.
have lost everything. I would have lost 200,000 plus my family's money, my money, whatever, you know. So that would have been catastrophic. So I'm very happy. I lost everything early on, so I focused on investing my time on the right things, which were like university, studying, and getting market experience, getting to know the FX market, getting to know equities, getting to know fixed income. Trading them on a day-to-day basis has really helped me also understand how markets react to events. Like in university, they'll tell you, okay, US inflation is going up, so the dollar should depreciate. But then you go to markets, inflation print is higher than expected, and you see euro dollar go down 1%. Why? Because the market is discounted higher interest rates, you know? So you always, with markets, you need to go to the second, third, fourth order effect. Something that they don't teach you at university, and you have to learn by being exposed, you know? And that's also something I did very early on. I gained exposure since day one.
And you said you started with options in that first phase. How did you even choose your expiry date and your strike price?
No, I didn't even know what an option was. I only saw it went up by 200%. Like in
But
plus.
then you still got to choose your expiry and strike. And so how did you click randomly or like?
Yeah, I mean, in these retail brokers, at the top of the page, you can see the symbols that went up the most in a day.
Okay.
So I just clicked there and I saw, okay, Alibaba call option was up like 300%. So I clicked and I bought the momentum, you know?
So you did the opposite of your current strategy, which is very mean reversion based. Here you bought what went up and
Yeah, in my strategy, we have both mean reversion and trend following.
yeah.
And some analysts are mean reverting analysts, some analysts are trend following. So based on the results, we decide, and based also on the asset, the nature of the asset. In my case, yeah, I was just naively following the momentum. You know, I didn't even know what was an option. I didn't even know I could lose everything. Yeah.
That's I always find it crazy when people go straight into options and yeah, I think just the decay of those options is already very very dangerous.
Yeah, I mean, but I was young, I was gambling, I didn't even care about what an option was till I lost all of my money. So that's also some things people might think, you know, so especially young people, one quick box. They see options are really volatile. They have high volatility to the upside, you know, and to the downside. So it's an attractive product from that point of view.
And by the way, what do you think about zero DTE options that are booming these days? What's your view on that?
Yeah, my view is they are very interesting product because they allow managers to hedge specific events. without paying time premium, extra time premium. For example, if you have a Fed decision this afternoon, you can buy a 0 DTE and hedge only this event. So it's a product, it's very good for hedging purposes, but also people use it to speculate. I mean, it creates a lot of hidden leverage within the system, no? Because options have very big multipliers. So one contract could be like 100 shares underlying, and the nominals are huge. So if market makers, maybe I don't know if something could happen there. We've seen similar problems like financial breaking because of this. So maybe we could see something break around there. But with current technology, it's less likely. Market makers have become really sophisticated, and in reality, when you're buying a 0 DTE, your chances of losing money are very high, since the implied volatility usually is very high.
Understood. And by the way, in your fund strategy, are you using any options, or it's just plain ETFs?
Not for the moment. We prefer not to pay premiums unless we could buy options for hedging only, but we are currently not doing it to avoid these premium costs. We try to minimize costs to the max. It's also one of our top priorities: minimum turnover, minimum commissions, minimum, because in the end it removes a lot of the compounded interest.
Understood. And a few fire questions to end this conversation. If you were to choose a camp between the Trump and Besant side and Jay Powell side in their clash on interest rates, where do you stand?
Yeah, very good question. I think what Trump is doing right now is completely crazy, and I don't understand how Besant isn't telling him like how interest rates work. If he wants interest rates to go down, he cannot remove Jerome Powell from the position, because I mean, okay, short-term interest rates 1 month can go down if Jerome Powell says so, but like 10-year, 5-year, 20-year rates are not determined by the Fed. They are determined by the market confidence in the dollar, because in the end, fixed income is a bet on the dollar maintaining its purchase power. Otherwise, why would you want 5% if inflation is like 20% or the dollar is worth nothing? That would be what happens if monetary policy clashes with fiscal policy. There always should be a separation. So I don't understand why Trump is taking that stance if his objective is to reduce interest rates. I mean, if he wants to reduce interest rates, he should reduce inflation. He should cut fiscal spending. That's to start with, and reduce economic activity. Then we will see interest rates go down. But of course, I really don't understand what Trump's strategy is with the Fed. It's completely wrong, in my opinion.
And a similar question on the debate between the Elon Musk side and the Trump side on that big, beautiful bill. Where do you stand?
I mean, Elon Musk, in my opinion, committed a great mistake siding with like going into politics. Why? Because it's the easiest way to lose 50% of your customers, right? So him siding with the Republicans made Democrats don't want to buy his cars. He's in the news. There's problems right there. It adds volatility to Tesla, to the brand image of Tesla. So in my opinion, that's not very smart. I also think he needed this. Why? Because China was becoming a huge threat. In the end, Tesla is not a car company, it's an AI company, it's a data company, and they need their cars to collect as much data as possible. And how do they do this? By having the most cars in the road. In the end, when you are riding the Tesla, the car is recording your surroundings, and it's also recording how you react to your surroundings. which then they use to train their AI models, to drive. So they need the most amount of cars in the road. And if China competition comes in, they will have less cars in the road, and China will take advantage of this. So Trump, he knew, was more protectionist. He won't allow Chinese cars to come without huge tariffs. So he knew Tesla would do better with Trump on paper, and also, he also took a stance on fiscal spending. He joined Doge, and he, of course, what he says makes perfect sense. There's a lot of corruption, useless spending in the US, like in Europe, and everybody, like politicians, and yeah, you can cut costs. That would make interest rates in the US go down. Of course, that would be very beneficial to the economy, reduce inflation, it would make the economic, it would be more, it would boost economic productivity. And I'm with Elon Musk on that one. Trump said he would cut costs. Budget is, I think, is the same or even higher. So, this can get out of control. We already have the US on 130% debt to GDP, a completely unsustainable path with 6% deficits. In my opinion, it's crazy, and that's how we include gold in the portfolio because of this.
So the Besant and Trump view on this is to grow their way out of their debt problem, and the Musk side of things would be actually we should do the opposite and actually be more conservative and solve our debt problem with less spending. And so there's really two schools on that, and so I guess you take the Musk view and
Yeah,
stand against the Scott
to
view.
grow debt by GDP, you have to allocate this money efficiently to boost productivity. But if you allocate this money inefficiently, it's what Musk says. Okay, you have to spend, but spend it efficiently on economically productive assets, in order to grow your way out of it. But spending like crazy, like drunken sailors, is not gonna result in economic productivity. It's gonna result in stagflation and economic inequality rising, and that's really bad for equities, for fixed income. The only asset that can benefit in that type of environment is gold. And for the moment, I think there's a low chance of this happening, but there's a chance. So including gold in portfolios, in my opinion, is reasonable.
Understood. Other question, the USD losing its status as a reserve currency like many other currencies have in the past. What do you think?
With Trump doing what he's doing, it's a possibility, but in another side of the coin is that Trump will be here for 4 years only. And whatever damage he causes to the legal system or whatever will get repaired, and investor confidence will be restored. Also, the dollar is backed by the US military, which is one of the biggest forces in the world. It also has the biggest financial institutions. Most of the world debt is denominated in dollars. So that creates a perpetual demand for dollars. So it's really hard to get the dollar out of the system. Even futures, derivatives, everything is priced in dollars. So how can you get that out of the system? It's completely impossible. You would have to destroy capitalism to get the dollar out of the system. And plus add the technological revolution that is happening. The US is the main player in this. So this also creates demand for dollars. If you want to pay for NVIDIA data center, you're going to have to do it in dollars. You're not going to do it in euros. So this creates a demand for dollars. In my opinion, the dollar will not lose its reserve status unless the legal system becomes compromised or Trump does some crazy thing I cannot even imagine. But even though, if that happens, the system, like it has always done, will repair itself and become stronger. So I don't believe this will ever happen, at least in my lifetime or or unless Russia destroys the US with a nuclear bomb or some crazy event happens, you know.
And if it were to happen, what do you think would be the next alternative as a
I
currency?
mean, if there, like, it could be the euro directly, could be maybe gold, tokenized gold or something, backed by gold, by a physical thing, or Bitcoin. I mean, Bitcoin, our generation, like my generation, thinks Bitcoin is a store of value. So if this belief, I mean, Bitcoin is really volatile for a store of value, but I don't know, maybe it could be instated in the economy. It's crazy, but maybe it's the future. I mean, it's decentralized, it's efficient, a transaction ledger, so it could be a possibility.
Do you have a crypto allocation yourself?
For the moment, I'm 100% invested in my fund, so I don't have a crypto allocation.
Right. Okay. Understood. Well, personally, I recommend that anyone has a 2 to 5%
Yeah.
allocation, which is small enough to not be a major risk, but still there to give some potential upside. And what's interesting with Bitcoin is that it's proving to be both a risk on and risk off
Yeah.
asset as well.
Yeah. The correlation is surprisingly low for daily returns. Like, even if they say no, the Bitcoin and the Nasdaq are very highly correlated. If you look at daily returns, they are not. They're very correlated. Maybe on yearly returns, but not on daily ones. So it actually historically has given you a diversification effect to own Bitcoin in a portfolio, and also you can combine it with gold. Like, I did a video on this. It's on Spanish, but it's on my YouTube channel. And I basically say that the efficient frontier, if you analyze Bitcoin and gold, is around 80% gold, 20% Bitcoin. And you get a pretty good performing portfolio, like even risk adjusted.
Yeah, understood. We didn't speak about emerging markets. Very quickly, what's your view on LATAM? What's happening in some places like Argentina?
Yeah.
Is your fund positioned on emerging markets today and specifically LATAM?
Yeah, we have some exposure through the MSCI All Country World Index, which have some allocation to emerging markets, a little one, but it has one.
Mhm.
And in my view, personal view, I think there's a huge opportunity now in this market. Why? Because AI has the potential to increase the rate of economic growth. I mean, AI is a productivity enhancer.
Yeah.
And also their valuations are very low compared to developed markets where AI is also a productivity enhancer, but some of these enhancements are already priced in. Meanwhile, in emerging markets, really, there's nothing about this priced in, and I think it can start to be priced in and grow. So, I mean, on the fund, we are not overweight emerging markets statically, but fundamentally, in my opinion, I am bullish on emerging markets on a fundamental basis, yeah, because of this. I mean, AI is a huge macro tailwind for them.
And why do you think your fund, so your top AI analysts are not recommending more exposure to EMC?
I mean, because they work on historical data,
Yeah.
and historically speaking, when you compare emerging market exposure to, for example, tech, even when you go to similar circumstances like this, the risk reward has always tilted towards tech rather to emerging markets. You have seen emerging markets performance hasn't been really that good historically. But of course, with AI, with the implementation of these new technologies, boosting margins, increasing productivity, everything can change, and emerging markets can start performing very well. So this is also some human input you can add to the model.
What's been the model's best bets and worst bets so far?
So far, the worst bet has been on gold,
Uh-huh.
and the best bet has been on
Why on
technology.
gold? Why is the worst bet been on
Be-
gold?
Gold in terms of performance. Since we started the 5th of May 2025, gold did, like, I think minus 2% on the first rebalance. And well, we had an
But here
allocation
you're
to it.
talking, as you started, you're taking your living date, which is when your fund went live. But before that, you were running it. You were running the same
Yeah,
strategy.
gold has been a very good asset to own. I mean, but since I started, gold has been the worst performer and tech has been the best performer. Yeah.
Are you saying since you started in 2022 or when you went
No,
live
no,
with?
no. I mean, since I started live, like the fund working
Yeah,
on May 5th, 2025. Before, gold has been our best asset.
yeah,
Like I started posting on LinkedIn our model portfolio,
yeah,
and we had like a 20% allocation when people had zero allocation back in October 2023.
yeah.
And nobody was bullish on gold, and our models were very bullish on gold given the fundamentals.
Yeah.
And since we have outperformed the 60/40 by a wide margin, and our major competitors such as BlackRock, Global Allocation Fund with 15 billion AUM, and this
What's your
gold allocation has given us a lot of alpha.
So, like, what's your cumulative alpha um, compared to the BlackRock Global Asset Allocation
Since
since
well,
since
our
20,
model historically, you mean?
yeah, since 2022?
Since 2022, I would have to check on you with that exact figure, but historically it has generated around 2% alpha.
Understood.
Yeah,
And
2 to 3%. Yeah.
yeah, and which is it's pretty and I think you have less volatility as well.
Compared to the BlackRock Global Allocation, I have a little bit more volatility. Like I
Mhm.
think the BlackRock Global Allocation Fund has 6% vol, and I have 7.8 or 8% vol, but I have much higher returns. They have 5% returns, while I have 8% average returns.
Yeah, yeah, which is pretty incredible for
Long only, yeah,
a strategy that you've implemented and coded by yourself.
yeah,
But what's great is you have the perfect combination between financial economic knowledge on one side and then programming, uh,
yeah,
being an IT knowledge, and it's very rare. You see a lot of guys in the market that have financial economic knowledge, but lack the other. And similarly, even in the best quant funds, you'll see some amazing physicists and coders, but they don't know how to relate their programming uh,
yeah.
to financial knowledge, and having that combination is very unique.
Yeah, yeah. Thanks for highlighting that because that's exactly why I founded Alpha Rho Technologies. Because I was working at a fund, I saw how they worked, like they were using Excel, and I mean, once I learned how to program, I saw that they were in a huge disadvantage. Like Excel is very good for visualizing, presenting stuff, but it's really bad for analyzing stuff. A computer can do much faster calculations, much in detail, backtests, whatever, that
Right.
Excel cannot do. And because I had this learning path, I studied finance. I then worked at a hedge fund, and then I learned how to code. Is what gave me, in my opinion, an edge because I know finance and now I know how to code.
Yeah.
So I don't have the friction usually financial professionals have. Like a CIO has a lot of financial knowledge, but he doesn't know what a coder or what a computer is capable of doing, and the
Yeah.
coder knows this, but he doesn't know what to code, so he cannot give any financial input to the CIO. Say, we can backtest a million strategies in 1 minute. Like the coder doesn't even know how to generate that prompt to the CIO. So when you remove this friction, in my case, in myself, you get to develop Alpha Rho Technologies.
Understood. And so, if a retail investor wants to invest in your fund that went live in May, how can one do it?
For the moment, if it's the retail investor comes from Spain, it's very easy. You just sign up in the platform called My Investor. It has around 500,000 users already, and you sign up and you can buy the fund by searching the eSIM code, which is available in my website, which is Manuel Ritsch is my name .com. and there you will find instructions. And if you are an international investor, you can email me to my email, which we will leave in the description of this YouTube video. And I will try to find a solution on how to invest, because right now it's a Spanish fund, so it's UCITS, which is a European passport. In theory, any European can buy the fund without any problem, but the bank has to open it in the system, in their systems. So there has to be some procedure there, which I can help you with. And in case you're a US investor, for the moment, I don't know if you can invest directly in a European fund. I've tried to put this fund in Interactive Brokers, but they told me they don't allow for the moment European Spanish UCITS fund. So I don't know if it's possible. Maybe if you create an account in Luxembourg, which I can help you with, you can gain exposure to the fund. Just email me and we will try to find a solution.
Understood. And just to clarify, there's zero bias or incentive here on my part to be talking about your fund. This is purely objective and zero economic bias. Although I am myself one of those people who will be investing just like any other retail investor, and in my case, a non-Spanish investor.
Thank you very much, Nathan, for your confidence in the strategy and in me.
Well,
appreciate that since the beginning.
And Emmanuel, again, incredibly well done. It's just amazing to see a 24-year-old who is self-taught, at least in the biggest chunk of the practical things, and goes to launch in partnership with a big bank in Spain at only 24-year-old a quantitative macro strategy, and just has in general built the level of knowledge that you have in both economics, finance, but also programming. I've been active in finance since 2008 in investment banking, and I have never seen a 24-year-old with the level of knowledge that you have. And so I can only imagine what you'll achieve when you get to 30 and 40. I think you're clearly one of the most promising young financial guys out there.
Thank you very much, Nathan, for your very kind words. I hope we can talk again and we can discuss financial matters whenever you want. It's a pleasure for me to be sharing time with you also. And I also want to appreciate that you've been with me like for the past 2-3 years, helping me throughout this process. And we've been talking, and it's been a huge pleasure for me to be in contact with you.
With pleasure.
Thank you very much.
Another podcast and catch up on the markets in a couple of quarters from now. Thank you, Manuel. Have a great evening, and thank you, everyone.
Thank you, everyone. Thank you. Bye-bye.